Welcome to another episode of the Tech CFO podcast. I am really excited about this episode. Today we're interviewing Dustin Snyder, and he's the director of finance at a tech company called Banyan. And Banyan is experiencing hyper growth. From the time that Dustin started just a couple years ago, they've gone from like 30 employees to now well over 100. In this episode, we're going to talk about how that role has changed in that growth curve, internal versus third-party accounting and the pros and cons. One of the things that I'm really excited for you to hear about is something that Dustin calls the client cube. It's this really simple set of data that you can maintain in a spreadsheet, but it allows you to measure things like MRR, your churn, new MRR, ending MRR, your LTV. It's this, as Dustin calls it, this treasure trove or fountain of BI and can be used for data investigation and projections for your cash flow models. And it's just probably one of the more useful things that I've ever encountered, and I think you're really going to like it. He's got a genius take on cash budgets. We're going to talk about the transition from cash accounting over to accrual. Just a whole heap of awesome stuff and a lot more than what I just mentioned there. So just real quick, I just want to let you know that this podcast is brought to you by us here at Capshare. Capshare is a tool that allows you to manage your equity in the cloud. You can issue stock and manage your shareholders in one easy place, even doing things like stock option expensing or 498 valuations. It's an amazing tool for analyzing term sheets, doing round modeling, seeing what people get in cases of an exit. If you want to check it out, you can go to capshare.com.
Great.
All right.
You take it away.
Awesome. Well, we're excited to have Dustin here with Banyan, and I think you have a lot of talking points that you kind of forwarded on to us that really excited to kind of get into as many as we can, get as much value from that. But if we can start off with just a quick intro on Banyan and a little bit about yourself, that would be awesome.
Certainly. Well, again, my name is Dustin Snyder. I'm the Director of Finance here at Banyan. I was the first accounting finance hire. I came on when there was probably about 30 employees with the company, and I've seen it go from 30 all the way up to 100 plus, and experienced a lot of headaches during that 2 years, and learned a lot of great things. So hopefully we can share some of that with the viewers, so they don't have to go through the same headaches that I experienced. Banyan itself is a marketing software as a service company. So the way I like to explain it is when I moved I'm originally from Portland, Oregon.
Okay, cool.
Moved to Utah about 3 years ago. And when you do that, you've got to totally find new healthcare providers, new dentists, new doctors, the works. And so, what do most people do in that given situation nowadays?
Probably Google it, right? Or maybe talk to their friends or ask around on social networks, or I don't know, something like that.
Yeah, definitely look at the reviews.
Yep. And that's exactly what I did. I jumped on Google and I said, for example, dentist near me. And you see the ones that come to the top of the list, and then you start looking at the reviews and who has quantity and quality. You jump into the website and you want to get a feel for the culture and see who the doctor is, what he looks like. And so those are two areas that we can help healthcare professionals with. I said dentist because we started off in that industry.
Oh, cool.
But we've branched out to all of healthcare. We were formerly Social Dental, now we're Banyan, and our trademark is to branch out. That's what we're doing as a company. We offer review software that help healthcare professionals to kind of capture the pent-up goodwill, so to speak, that every good doctor has patients that love them, and a lot of times the reviews are just kind of sitting there waiting to be solicited and captured online. And so our software enables doctors to solicit those reviews and to convert them and get them on Google, get them on Facebook. where people can see them, right?
Cool.
We also help out with the websites, because your first impression of a healthcare provider is generally their website, and if their website sucks, you're probably going to move on to the next guy. So and then we have a social software that, because of HIPAA, you've got to be careful what you share on Twitter, Facebook, and Instagram with the public, right? You could get in a lot of trouble. So we've created a platform that enables doctors or healthcare professionals to share pictures of their patients online in a compliant way.
Cool.
And then last but not least, we have some listing software that, if there's over 70 plus listings providers out there where you can find information about businesses, and our software cleans that up and makes sure that it's consistent across those directories, which I believe, this is the finance guy talking, but I believe that helps SEO. Is my understanding. Yeah. But that's the gist of what Banyan does.
That's perfect. You sound like you're out of the marketing department, my friend. Maybe you're calling. Maybe you haven't quite found where you quite your perfect niche. It might actually be in a different area.
One of these days I might move into sales, but I have been to a convention. I have actually closed the deal at a convention. Which will forever go down in history. Finance guys are people too. We can get in there. We can close deals if we need to. So.
Like a true startup.
Yeah.
And I guarantee the accounting on that deal was perfect.
I honestly have no idea. I hope it was.
Thanks for that intro. That's
great
awesome.
intro.
Yeah, it gives people a good sense of kind of where you're at as a company, which I think gives a lot of context for. There's so many people going through that stage that you just described. We're going from kind of that 30 employee range up to the 100 plus. There is so much that goes on.
Yeah.
And so I think it's going to be awesome to hear a little bit about kind of what you saw, what you dealt with, and how you took it through that kind of transition process.
Yeah. It comes at you fast. We experienced and are experiencing hyper growth, and I've never experienced that before I came to work at Banyan, and it was a slap in the face, for sure. And there's definitely things, if I could go back, that I would do differently. So hopefully we'll touch on a few of those things. I'll give a little bit of a taste of my background before we get into that. I started out as a senior analyst at a company called Moss Adams. It's one of the big 15 accounting firms.
Familiar with Moss.
Great company. Firm. Maybe there's going to be some listeners that want to become a director of finance or something someday. My path was kind of interesting. So I started out at Moss. I was on their consulting side, and I specialized in business valuation. So I got to see lots of different companies, software, manufacturing, forestry, all over the board, see how they worked, dig into the numbers, learned some great financial analysis tools, how to model, how to DCF, how to do market valuations. And all those tools really, I was there for about 4 years, and all those tools combined really helped lay a solid foundation for getting into corporate finance. So I know I talked to a lot of people who do the VC route, which is also a great route. You get those kind of the same tools doing that. After, I kind of got the bug when I was at Moss Adams to be an operator, to see what it's like being inside the company, because I was always on the outside looking in. So before I went long haul there, I wanted to see what it was like, and I had an opportunity to come work in Utah for a company called Whitecap Institute, which it was a holding company that had about 4 operating companies. One was a dental lab, one was a dental practice, one was continuing ed, and an e-commerce.
Wow.
So I was looking over all those from a financial and an operating perspective, and really learned a lot. And I was only there for a year because this opportunity came, and I wanted to get into software, but I learned a ton while I was there. Plus, it exposed me to kind of our primary target market, which is general dentistry. So it gave me it's a pretty good background.
Yeah, no kidding.
Yeah, and then the CEO of Banyan, Tom Clark, we grew up together. He's a good friend, and he reached out to me. He needed a finance guy. That's what my position was. It was finance guy. And little did I know that was
everything finance.
Finance. That was accounting. That was HR,
Oh,
that
wow.
was in-house legal.
Probably investor relations.
Investor
a little
relations,
bit. I mean,
yeah.
seriously. I mean, yeah.
Yeah, you wear a ton of hats. As
Probably
a-
some operational stuff too. I mean, sometimes it bleeds,
Yeah.
right? Yeah.
Yeah, systems implementations. I mean, we're on moving to our third billing software. I've been involved in all
Yeah,
that kind of
huge.
stuff. It's a lot of work.
Yeah.
But one of the things I wanted to share with the viewers was, if you're going to go work at a startup, you're going to wear multiple hats, especially if you're in the finance accounting, or if you're the first finance guy at your organization. And if you are above doing AP, AR, and chargebacks, it's not for you. Just disengage. Because you're going to do a lot of things.
Pull the ripcord.
Yeah.
that's
Pull the
really-
e-brake, flip a U, because you're going to do a lot of things that, that are definitely above your skill set. But at the same time, very important to the business.
Yep.
So if that's not your cup of tea, go work for a big company where there's other people doing that stuff. But part of the fun of being at a startup is you get to see everything, and you get to be a part of kind of putting in processes for all those
Yes.
things.
Yeah.
It's really the Wild West,
Yeah.
and you're there to to tame it, so to speak.
Yep.
That's awesome.
Yep, I can relate with that. Yeah, implementing process I think is one of the most sometimes grueling, but also most rewarding things I think that you can do, and just makes startups so fun.
Yeah.
Huge ROI for sure. Huge return on investment, from streamlining processes. But yeah, I think that's great for our listeners, honestly, to hear that story. So appreciate you sharing that.
Yeah. No problem.
So should we transition now to talking about so for our listeners, Dustin actually sent over to us kind of a list of some topics that he felt like were kind of critical issues that you've dealt with, right, over the past 2 years here.
Yeah, like everything I've screwed up on. Seriously.
Okay, great. So, I mean, but what better thing to hear, right? To learn, hey, what to avoid, right? This is almost like the top 5 things to avoid, or 10. Actually, the list is, I think, a little longer. How many is it? Anyway, we'll go through this, but we're gonna maybe talk through it in order if that works for you, or maybe in a logical order that works for you. So with that, maybe we can turn time over to you. Mike, did you have anything you want to add to that? Okay,
I think
great.
I'll let you kind of decide where you kind of want to start, and love
Sure.
to kind of dig in, ask some questions about whatever it is that you choose.
Sure. Well,
We'll try not to interrupt too much, but I'll reserve the right to ask a few questions
Of course.
for clarifying.
Of course.
Things like that.
So one of the first things I sent over was I wanted to talk a little bit about how my role has changed here at Banyan over the last couple of years. You go from wearing multiple hats, and then you grow, and it just at some point there's a breaking point where I broke. I just couldn't. Transactional volume goes from 300 a month to 1,000 a month. Complexities of having multiple departments in the organization. There comes a time where you need to bring in help.
Yep.
And one of the things I wanted to talk to was the controller role.
Yep.
Yes.
I actually really enjoyed playing the controller for a while when transactional volume was manageable. I got to set up the chart of accounts. I mean, we had no cost of goods sold. In our P&L, when I showed up, it was just cash receipts, expenses, profit or loss.
Yeah.
And so I got to jump in and kind of set that up the way that I wanted to. And
Were you on QuickBooks at the time?
QBO.
Okay, yeah, QuickBooks.
And
Online.
QBO still is what we use.
Yep.
It's working out.
That's
It's
great.
working out fine for us. There will be a day when it just isn't robust enough.
Yep.
I know our controller would love some automated RevRec capabilities, which QBO just doesn't provide.
Yep.
And I'll talk a little bit about that and a remedy for that.
Oh, cool.
Great.
Yeah, that'd be great.
So where was I going? It just
plain controller role.
Yeah. So finance is a forward-looking role, and if you're spending time in the books, too much time in the books, it seriously sucks you in. I have so much respect for accountants. I love them. I love the information they provide to finance to be able to look ahead and forecast and do all that stuff. But if you're trying to be the controller, you will get sucked into that world, and you will spend most of your time looking in the rearview mirror.
Yep.
When what the company needs, especially at an early stage, with fundraising, there's constant need for updated forecasts and
Totally.
all that kind of stuff, right? Knowing what your runway is.
Yes.
They need somebody to look forward.
Yeah.
So, we brought on a controller. It was probably around 5.5 million run rate. If I could have gotten one at 4, I tried to, but it kind of got pushed off a little bit. But the earlier you can get a controller in, the better, because that will enable you to really focus on what your true role is, and that's to look ahead and to turn the business strategy into a financial model to help guide and direct the company. So that's one tidbit for CEOs and founders out there. Don't push it off too long, because then you're going to end up paying for it later. Because let's be honest, cash accounting is one thing, but GAAP is another monster. And the longer you wait, the more stuff a controller is going to have to sift through. I think when our controller started, he had to go through like 40,000 lines of transactions.
Oh my word!
Wow.
And this was up against a deadline of doing a review. So it's not like he got the privilege of taking his time on it.
Right.
He did a great job. We passed our review, but if I could have had him a year prior, it would have been.
And by the way, can I just put a pin in that for a second, or double click on that, just for those who are a little bit less experienced than you are? A review is the level, a step that comes before an audit, right? Typically, you'll engage an audit firm to do a review, generally like a year, 18 months, sometimes even 24 months before you're actually anticipating an audit, right?
Yeah.
And so it's to help you get ready for an audit, so it's not quite so onerous to make the full jump to a full audit, right?
It's a warm up. If you had to go as a startup from cash to accrual and then instantaneously be audited, it'd be a nightmare. Even going through the review.
Well, you honestly, they probably wouldn't sign off. It's bad.
Yeah.
So
even going through the review was a headache.
Really
it was
painful.
a lot of work. But yeah, I couldn't have done it. I couldn't have done it by myself. Absolutely not. And I don't think I could have done it with third-party help. There's just you don't get. It's not having somebody look outside in and doing your books. That works for a while. This is one of my talking points as well. Was third-party versus internal accounting. And so I'm spending a lot of time talking about accounting, but the better your data is, the better your accounting is, the better, the easier your life is going to be as a finance professional, because you rely on all that information. Heaven forbid you're the guy that's creating it too.
Yep.
So, honestly, when you're starting out, budgets are tight. You're probably going to have to use a third party for a while.
Yep.
And that's just the way it is. But there will come a time when you just need better financials. You need better information to pull from them. S&M expense becomes very important if you want to know what your customer acquisition cost is, if you're keeping track of that, your payback period. All these numbers have an accounting input.
Yep.
So, and outside a third party, they can't compete with somebody on the inside that can walk out of their office and talk to the marketing director, talk to the sales director, and get the insider information on where these expenses should go, how they should be classified, how they should be treated. So, again, founder, CEO advice here, hire the controller as early as you can.
Yep.
It will save you so much headache down the road.
Yeah, and where could you I also wanted to kind of you already mentioned it, but I want to kind of highlight it. Where do you think that transition period is? Maybe speak for a SaaS company at least. Where do you think that transition period is? I know you said as early as you can, but
when it becomes necessary.
Yeah, like when is that typically going to become necessary? Is it 2-3 million in revenue? Is it 4 million in revenue? Is it 5?
For me.
Is it not revenue based? Does it depend on
it's
the complexity of your
it's
business?
transactional. So how many transactions are coming in on a monthly basis? I was doing 300 a month, and that was fine.
Yeah.
If I was coming in and I was booking 10 to 15 entries a day, not a big deal.
Yep.
But as soon as that becomes 100 a day, then it's like, okay, I'm spending all day doing this. I'm getting behind on what I should be doing.
That's perfect. That's exactly what I was looking for. Yep.
And as the complexities of the business grow, number of vendors, number of business units, if you want to have departmental budgets, all that kind of stuff, you need the controller. If I were to put a number on it, for us, I was feeling lots of pain around $4 million
in recurring revenues,
annual recurring revenue. Yeah.
That's great. That's great. That's a great benchmark.
But you need to start
earlier.
You need to start pitching a fit, raising your hand earlier, because you're probably not going to get one right away.
Right. That's good advice.
And that's actually the other thing that I want to get through your points, honestly, but I think it is a great point you bring up. Startups are notorious for investing heavily in kind of what's going to drive the growth engine, and the CEOs, like myself, CapShare, we're often really, really focused on sales and marketing or dev, but accounting is sometimes a little bit of an afterthought, right? It's like, hey, do I really need to spend on this? So, but I loved your point that, hey, this accounting data becomes the underlying data that is going to help us in fundraising. It's going to help us in payback periods. It's going to help us in ROI analysis.
It determines the decisions.
It's
in
the
all the
language. It's the language of decision making, right?
Yes.
For the business. So it's pretty critical to get it right. And I think you're right. You probably will find, in my opinion, as a finance professional, I think you're going to find you have to start pounding that table a little earlier than you probably are going to be comfortable with to get your CEO to kind of say, yeah, this is important. Something I really want to spend on.
Yeah, so humble yourselves. We think we can do so much. Like finance people and accounting people are they're workhorses. It's not rocket science. It's a time thing.
Yeah.
Really. I mean, so obviously, if it's a time thing, you need more bodies.
Yep.
And you don't need a ton. I mean, we just have one controller.
That's great.
One director of finance. We have a VP of, and I'm talking kind of operations. We have a VP of operations that oversees finance and accounting.
Yep.
We have an in-house legal guy now, and so my position went from one, and now we're 4 or 5 people.
That's great.
But we still don't have tons of folks under us doing the the number crunching.
Yep.
We're still at a point where we can manage that ourselves.
Yeah. That's great
but
advice.
It's great.
Cool.
Well, let's go to your second topic then.
Yeah.
Really appreciate that first one. It's great.
Next thing I kind of wanted to touch on, and these aren't in any order of importance.
That's fine. Yeah.
Was something that's called the Client Cube.
Yes, I was curious about that.
Yeah. This was something that we were introduced to during fundraising.
Cool.
It was one of our a VC firm this was how they looked at our business, and essentially what a cube is, it's an Excel model if you can't afford some kind of robust software, but Excel model's fine. It's just a model that has a line item for every one of your customers that you sign up throughout your entire, from beginning to current day. And you want to have in there, you want to have a start date, contract end date, how many business units. So people like to look at logos, but you also need to look at how many units are within that logo for certain analysis. Like if you're trying to calculate like a customer acquisition cost, you don't want to use a logo. You want to use locations.
Yep.
So you want that
that's
in there.
particularly relevant for your business, right?
Yeah.
Because you might sign up a chain of practices.
Yeah, we have
that.
DSOs,
Right.
dental service organizations, which could be up to 800, 1,000 locations.
Totally. And CapShare, by the way, is very different. A logo generally for us is like that. That's the client, right?
Right.
So it's like one per logo. But I think it's important. I just wanted to, for our listeners, point out that for you that's not the case, because you're trying to get probably to a customer acquisition type of thinking. So every one of those locations is like a new paying customer for you.
Right. If I sign up an 800 practice DSO and I only put one in the denominator of your CAC formula, it's going to make it look really awful.
Yeah.
So you want to track that, units, start date, end date, and then every month what they were supposed to pay you from a contractual standpoint. We don't really care about whether they paid you, but what were they supposed to pay you? Because let the AR
do its
clerk
job and
deal
do
with
the
collections and stuff like that.
Yep.
And so with all that data, it's really simple. But the hard part is if you've gone in business for 2 or 3 years and you don't have that, all of a sudden you're digging back in time to find all the historical data, which I had to do, and it was not fun. I'm diving into the gateway, the credit card processor to see payments that came in.
That's rough.
It was super rough. But updating that on a monthly basis, bringing in new accounts, and then seeing what everybody paid you is a VLOOKUP in Excel. It's not too difficult. But with that one set of data, now you can measure monthly recurring revenue. You can measure churn, new MRR, ending MRR. So your MRR roll up, right? You can measure in there. You can get your logo churn numbers, which you need to know to calculate an LTV and all this other stuff. So it's a fountain of data, and then you can slice it and dice it with pivot tables, and you'd be like, well, why did my retention suddenly plummet in this specific cohort? You can isolate that cohort and see and then find out why did so-and-so stop paying us. So it is the amount of BI and data investigation you can do with that one tool is awesome. And when I'm doing my forecast on a monthly basis, I'm continually going to the cube to update assumptions in my model. That is my source of truth for MRR.
That's cool.
And it's great when somebody internally or investors need that information.
Send it
Boom.
on to them. It's perfectly
Send
there.
it over. It's got like decay curves and retention tables already built out. It makes us look like we're really, really smart, even though we're not.
I would argue with that. Do you mind if I ask what does the cube mean in Client Cube?
I was wondering about that.
So
it's a matrix.
You can turn it and you can look at it
Okay. Got
different ways. Some people call it I think cube is like an audit term.
Okay.
When you get reviewed or audited, they're going to want a client file.
Okay.
Is another term for the client cube, but I've heard it called cube or file. We've stuck with cube because it's nerdy.
It's catchy. Hey,
Yeah.
I think that's a little
Good
marketing
alliteration
space.
too.
Yeah, Client Cube.
Yeah.
It's like,
Yeah.
That's cool. And can I ask one other thing
Yeah.
on this? Sorry, was I interrupting you there?
No, go ahead.
Okay. Do you do kind of a traditional, like a lot of SaaS companies, obviously track MRR, but what about LTV and CAC? Do you do LTV to CAC ratios? Do you look at payback periods?
Yep.
Is this the source for all that? Because it kind of come from the Client Cube.
A lot of it does.
Okay.
So like, if you want to calculate it's hard to calculate LTV for a company that's only been around for 3-4 years, right?
Yep. You got to make some assumptions
or even less.
churn. And
You got to take a monthly churn rate.
Yep.
And you got to work from there. Take the inverse of the monthly churn rate. That should give you a monthly life.
Yep.
Right? That comes from the cube. You can get average revenue per user from the cube, which take that,
That's awesome.
divide it by your monthly churn rate, boom, LTV.
Yep. That's
But
really
yeah,
neat.
we're looking at LTV to CAC. We're looking.
Do you
payback
discount?
period.
I'm getting to get a little technical. Do you discount your LTV at all? So you try
No.
to bring it. So
No.
it's just you just basically take your 1 over your churn rate, divide that into the average revenue per user, and that's going to give you your total, what your value of a customer is, and so you don't
Sure.
discount that back. Okay.
Yeah, I mean, I remember when I was fresh and I was building the LTV model out, and I was like, sweet, discount rates, like this is right up my alley, and I built it out that way, but then VCs and other people were like, nobody looks at that. Nobody cares about, or at least at our level.
CapShare's LTV to CAC just got about 10% better. I'm serious, because we discount it, and you're right, and so that's actually really good insight. VCs don't care about it.
At least at our stage.
Yeah.
They haven't.
No, I think you're probably right. Like, honestly, it gets pretty. I think that gets off into a little bit into some arcane stuff. Like, what's your discount rate? I mean,
Right. Which one did you
well,
choose?
and
Right.
for startups, we're valuation folks.
Yeah.
Dustin and I are both valuation folks. Startup discount rates can be like kind of ridiculously high, and so then it really hampers your LTV to CAC ratio. So I'm glad to hear that. Like, hey, let's just not play those games. Let's just look at the overall values and use these as kind of rough industry benchmarks that we then can kind of compare across different companies.
Yeah, it's like
That's good.
How are you going to justify a discount rate as a startup?
It's very hard.
As a startup, and if you're using 15%,
Yep.
anything below that,
That's kind of what we do.
It's
but
like-
yeah.
really?
I know.
That's all your risk?
Silly true.
It's a lot higher than that.
Yeah.
The other thing I was going to say is, if you're starting a company, you should create the cube, this tool from day one.
Yeah.
You're probably not going to have money to keep track of all this information in an automated fashion, but
Use a spreadsheet, right?
use a spreadsheet, keep this from day one, and you'll really be thinking, it'll bless your life
Totally.
down the road. You won't have to do a look back like I did, which was just awful.
I think that is just tremendous advice, Dustin. I'm serious.
Yeah.
I want to underline that, underscore it. We're gonna probably, pause, cut me out here on the video, but like I actually want to really make that part of a highlighted part of the written part of this interview.
No,
I
for
mean,
sure.
it's
I
a
would
really great piece of advice. So anyway,
And
we'll really make that.
We
a
might
big,
come back to you and be like, hey, we want to do a little bit more of a write-up on like
Or-
the client cube and like go in a little bit more detail, how to build it, or a little
or
bit
if we
of
could just get is there any way we could get that Excel model with dummy data, or even with just just the headers or something? Because then we can actually put it in the article, make it downloadable for you, and we're happy to I don't know if it'd be useful for you. Leads probably won't be useful for them. But anyway, we love that too because people then share their email addresses and we can talk to them and engage with them further and build our content.
Yeah, we could do like
I would love it if we could be
skeleton.
like, here's a skeleton cube. You heard Dustin talking about it. Here, you can download it here. So,
Yeah, and it's
really
it's
cool
really
tool,
not
man.
it's really not that sexy. People are going to open it and they're going to go, "This is it."
It's
But
as simple as tools that are often the most
Yeah.
effective, honestly.
Yeah.
So I mean, I wouldn't worry about that at all.
yeah, just you don't want to be building one when you have 1,000+ customers.
Totally. So anyway, back on. Great. I mean, that is really, I think, very helpful information. And we're going to try to include a link to a template cube in the article that will accompany the video. So thanks for sharing about that.
Yeah, no problem.
Maybe we could talk about the next order of business here.
Yeah.
Let's see. So next thing is a cash forecast. One thing I've seen people do is they'll build a nice, really complicated model, but they'll base it on MRR. But MRR does not equal cash receipts. So as a startup, you live and die by your cash balance. You live and die by knowing how much life you have left, and you need to know when you have 6 to 9 months of life left, because then it's fundraising.
It's fundraising time, hardcore, and you're right. You don't want to be off by 3 months on that, or even a month.
Right.
Really.
You can't afford that
No,
mistake.
seriously, yeah.
So it's great to have like a GAAP model. We don't. We really live and die by the cash forecast here, and so we actually have an in-house term that we refer to as CRR instead of MRR. It's just cash recurring revenue.
This is so great. This is so great. I mean, so you're several, probably a couple of years out ahead of Capture, but we're dealing with these things right now. So I mean, this is so germane to stuff we're struggling with at Capture on our accounting side. I was going to ask you. You mentioned it would be great to have a GAAP model, but GAAP isn't going to solve this problem either, right? Will it? I mean, what you really want is a cash. You want like a true kind of recurring cash number.
Yep.
And that number isn't necessarily going to show up anywhere in your GAAP financials. Will it? I don't think it would. Maybe on the cash flow statement if you were doing that perfectly or something. But
Yeah, I honestly don't even know.
I don't know. I don't think it would though. There's a piece of me that doesn't think it would. So anyway, I just wanted to kind of plug that this is something this is something where startups, you can think you're doing everything right and you can be doing a lot of things right, but you really need to get a handle on cash, and sometimes those numbers vary in very important ways from the traditional metrics you're used to reporting to investors like MRR, or even to metrics that you're using for metrics that you're using in your income statement, even if it's GAAP compliant.
Right.
So I just wanted to highlight that. Anyway, let's talk a little more about CRR. That's pretty fascinating.
Cash recurring revenue. So obviously you need to, if you're a business that has a lot of prepaids, there's going to be a big delta between your MRR and your CRR.
Totally.
Because you're getting that money up front. So what you'll want to do is you want to arrive at a number that,
which is a good thing.
Yeah.
I mean, it's a very good thing.
Upfront, it's great.
Yep.
It's really great if you can pull that off.
Right.
In kind of our neck of the woods with the size of deal we're doing, the customer we're dealing with, it's kind of a tough selling point, to be honest. So, most of our revenue is the monthly.
Month.
They're paying us monthly.
Yep.
So it's pretty simple just to download a report from your billing software and say, okay, who's paying me every month, and that's where you start.
Starting point.
Starting point.
Yep.
If chargebacks and AR are a pain point in your business, you'll need to factor that in. Factor declined credit cards.
Yep.
To kind of get at a safe cash recurring revenue number.
Yep.
And then you simply go from there. That's your top line, and then you line item out every one of your significant expenses when they pay you. Don't amortize it, because that doesn't do you any good. Especially if you're like a Salesforce client and you have an annual payment coming up that's $200,000+. Amortize that in a model and base runway on that. Are you kidding me? You can't do that.
Nope, you can't.
So the cash model is, we live and die by it.
Yeah.
And the most important assumption is that CRR at the top.
Have you ever made a push for profitability? You're probably growing so fast that I'm guessing that's not a strong priority of your investors. But I'm just curious if you have pushed for profitability, or if that's something that's on the radar or a consideration.
Never.
Okay, great.
No.
And I think
get market share.
Yeah, and I think that's by far the most common experience of most startups. But it's interesting because Capshare achieved profitability in May.
Nice.
We are back into unprofitability land right now because we're growing so fast. But we did make a push for a period of time to get there, and there's some interesting nuances to how you start thinking about expenses for us. You're absolutely right. Cash is really, really important for the average investor-backed startup, because you don't want to get cash negative or cash neutral before your next round, obviously. But when you are trying to drive towards profitability, you want to sort of amortize a little bit, because you want to start to think about, hey, when did I really cross over? Maybe my cash balance went up like crazy this month, but maybe I'm going to get another big hit a month from now, right? So you kind of want to see that.
You need the accrual P&L.
Yeah.
Because your ratios, your common size ratios, your gross margin, your operating margin, all that stuff makes way more sense on an accrual basis.
Totally does.
Smooths it out. So you need both. But you can't
but you can't go without the cash forecast.
Yeah, the day-to-day decisions.
Yeah, and that's something as a finance professional. My cash model is I open every day. I've got a folder for backups, old versions. Every day it's copy, paste into the backup folder. I've got my new dated version that I'm working on, and if somebody comes to me and they're like, "Hey, we need to hire," I plug it in, see what it does.
It's awesome.
It's a living document.
Oh, that's awesome.
It's a thing of beauty too. I mean,
I would love to see it, and maybe you don't give that away, because that's the special sauce. Maybe
that's your that's your job in finance. It's managing cash. It's not necessarily making sure that
did you invent that model? I mean, honestly, or did you start? What was your starting point? And maybe your old Moss Adam days, you had some kind of like a forecasting model, and you kind of hacked it. Yeah. I mean, is this something you again, if it's proprietary to Banyan, sure, we can take this offline. It's proprietary
if any of my Moss Adams friends ever want. When I left, I did not take anything with me. So I really started from scratch.
Okay, great. Yeah, good to know. And that's probably a smart thing to do coming in, because it really helps you to understand the business and to build a model, frankly, that's totally tailored to the specifics of your business.
That's the fun part of the job. Yeah. If you like being creative or want a creative element to your job, it's like building that model is where you get to exercise all that creative genius. If you have it. I'm not that creative, but I mean, I don't know. If you've worked with Excel models long enough, you kind of see the world as a giant Excel model. And
just a series of inputs and outputs with formulas in the middle.
Yeah. No, it's real life.
And then you understand why you can't talk to your head of HR using like Excel language or whatever. If that, anyway, dumb joke, but okay.
I've never heard anybody coin the term CRR, so
no, it's really cool.
That's a Banyan term.
That's Banyan. TM, trademarked.
We should trademark that.
I actually really like that a lot.
I do too. I thought it was really cool.
Yeah, we'll mention it, but we will attribute it to Banyan. Actually, we'll definitely mention it though. That's a really cool idea.
The next thing on my list was a cash budget.
Okay, cash budget.
Our forecast is up here, and then the cash budget is driven by what's in the forecast, right? So it's every month, it's we dump the inputs from the forecast departmentally into different buckets, and that's the starting point for the budget for that month.
Okay.
And we'll send that out on the 15th of every month, and we will get input. I call it the budget. We call it at Banyan the budget survey.
Okay.
And so it's just a Google Doc and a Google Sheet where they answer some critical questions. You know,
Is anything changing?
what's changing?
Yeah.
You know,
Deltas,
what
right?
should we know about that's
Yep.
going to impact our forecast? Are you going to be hiring? Do you need new software? So they fill out that Google Doc, and then we actually provide them with a Google Sheet, which I think you can get away with at this size of company. But as companies grow, I don't think they ever ask a director of a department to touch an Excel file,
Right.
or to populate it. We do it here. It works all right. Works pretty well.
Yeah.
They're used to it now, and they'll go in and they'll see what's in the forecast, what we think is going to happen. They'll update a few numbers for what
Right there.
based on what they know right in that file, and then they'll give me they'll type up a little explanation.
Dustin, can I ask you a question
Yeah.
on that? So one piece in this process that I'm kind of missing. I love it. I mean, it's really interesting. Who's authorizing those increases in budget? And maybe that's a whole separate conversation. But I'm just curious about that. Maybe at your stage, because this is an interesting thing at our stage at CapShare. Pretty much a lot of those authorizations are going through me or our president. So like the COO at CapShare, either me or the COO. Just because we're small enough still and growing rapidly that I can still kind of major in changes to investments I generally want to review.
Sure.
How does that work at your stage of company?
So we have.
And I don't want to lose your train of thought. So
that's
feel
fine.
free to answer it in like a sentence or two. I'm not trying to divert us.
There was a stage where it was just like that here at Banyan. It was
Tom.
It was the CEO and the founders.
Yep.
Everything kind of went through them, yay, nay. Now we have we call it the budget committee. It's comprised of myself, our controller, and our VP of operations.
Okay.
So we'll get all that new information from the budget survey, plug it into the forecast again, and I'll do a variance analysis. Say here's what changed. We'll look at the burn rate, and we'll say, you know what, either
no, we can't.
We're not comfortable with that, or we're comfortable with that. Let's do it.
Okay, Dustin,
and
I think
forward.
that definitely answered my question. Because the key piece of information I was missing there, and hopefully it's helpful for our listeners, is that budget tool you're using it's not saying, hey, this is what's going to happen. It's like a request.
Yeah.
It's like, hey, Dustin, we'd like to hire 2 heads.
Yep.
And then you take that back up to the budget committee, and that's actually your tool that you're going to use in the budget committee to be like, okay, there's a big delta in HR, they want to hire, and you're going to say, all right, sorry, and you're going to probably go back to your cash model and say like, well, look, could you just hire 1 right now? We're about ready to raise a new round, and we're a little tight until we get that new money in or something like that.
Yeah, and that's where the cross-departmental work comes in my job is every month is after they fill out that survey, I'll go and I'll sit down. If I have questions, I'll go sit down with we call them budget owners. So let's use a marketing director as an example. I'll go sit down with him and say, okay, I see you want some new hires. I see you want this and that. Help me understand. Now I'm the internal bank. Help me understand
why I should
why
loan to
you need
or
that.
give you some money. Yep, I like it.
Right? Because it's so easy. It's so easy just to say no.
Yep.
But the business speaks and lives and breathes and needs certain things, and so we try to really understand why people ask for what they ask, and I would say most of the time it all makes sense. Now there are the occasions where the ask is completely legitimate and it's something we need, but we're not comfortable with spending the money at the time, and we have to wait until that recurring revenue base increases to where we're comfortable to commit.
Yep, makes sense. So
great. Investors, it's hard to predict sales and control sales, right? You don't have much to say to that.
Yep.
You can't control somebody saying yes or no. You can do your best, but investors expect your expense forecast to be dialed because you can control all that. And I see that as a big part of my job is making sure that we don't blow our expense budget or gross burn out of the budget, out of the water, right? And it's something that we have kind of dialed in here, and it's this
Sure,
whole
your
this kind
board
of I
wants
gave you
that.
guys a really high level of our process internally, and it's worked really well for us here at Banyan. Sure, people will always complain about having to do the surveys. I can't blame them. They're busy. We were still multitasking and all that stuff, but I feel like expenses are under control here, and that's makes a happy finance guy
And it makes a happy board.
and happy board, happy investors.
Right.
And no mistakes on decisions, or at least minimal.
There's
mistakes.
nothing worse than rolling into a board meeting and saying that you blew your net cash burn number out of the water. VCs hate surprises.
Or they love it, but you should hate it as an entrepreneur, because
Yeah.
what they're going to say is like, "Oh yeah, we're happy to
Yeah.
give you another $5 million at the same pre or
Sure.
whatever." I mean, and you're kind of like, "What?" So
Sure.
I mean, yeah, you want to be in very tight control of
Yeah.
messaging, and when you're ready, when you want to take cash,
Right.
from the CEO perspective, you obviously want to do that when you can justify as big an uptick in valuation as possible, and so that makes tons of sense.
But what they do love is, we went over our spend
Yep.
significantly, but it was because we doubled our sales forecast,
Yep.
or something of that nature.
Yes.
Because we had to pay out all these commissions for all the new growth we had.
Yeah.
That's a little different. But again, you gotta own, as the finance pro, you've got to own the expenses of the company and control that
That's great.
with the help of a good controller.
Yeah.
Yes.
Kind of see topic 1 in this earlier in the video. We talked about that, but that's great. Great. So we head to the next item.
Cash to accrual. Did we?
We did not talk about that.
Okay.
So why don't we do that next?
Yeah. So
And maybe give us a little context for why that switch became necessary. Right.
Yeah,
It-
especially after all the CRR talk and how that's
Certainly.
kind of what you live and
it probably wouldn't have happened if had there not been some kind of impetus to move us that direction.
Okay.
So if you have
And just to put a bookmark in the video, we're now talking about kind of the transition that Banyan made from going from cash accounting to accrual accounting. Yep. So, sorry.
Yeah, no
Go
problem.
ahead. Yep.
So when you partner with a bank, the bank is going to want to see accrual financials.
Absolutely.
That was the main driver for us.
Got it.
So, and they were nice. They said year 1 reporting, we'll let you get by with a review, but next year, the year after that, it has to be audited.
Okay.
So for bankers out there, that's super appreciated, because if we had to go from cash to accrual and then get audited immediately, it
Would have been disastrous.
Would have been really hard.
Yeah. Okay, to talk to me about bankers again. You're very sophisticated. So again, assuming that some of the listeners aren't quite as far down the path as Banyan is. So bankers, are we talking about venture lenders here? Are we talking about traditional banks?
Venture debt.
Yeah. So probably venture debt. You're probably looking at the usual suspects, kind of Square One Bank, Comerica. I don't want to offend anybody, but obviously Silicon Valley Bank.
Yeah.
And I'm sure you probably talked to a bunch of these, right? And I apologize if I left someone out. First Republic, if you're in their heavier presence in California. A lot of these are more heavy in California, but those are some of the vendors out there.
Yeah.
So anyway, let's talk about. And do you mind if I ask which bank it was?
Sure, it was a Silicon Valley Bank.
Okay, so SVB, great.
And
So let's talk about that then. How did that?
So during our second seed round,
okay,
we
got introduced to them.
they piggybacked on that round. We did a 2.5-year growth capital term loan.
Perfect.
Great terms.
Great.
With a warrant for a very small interest in the company. I felt like it was extremely fair.
Yeah.
Not going that route, you go from a 4.5% to 5.5% interest rate to who knows. I didn't even look at other routes, but I'm sure it's 15%.
And why did you? And maybe this was a decision at the board level. Maybe it was Tom's decision, and maybe it was your decision. Why did you want to go the venture debt route instead of just raising a bunch of equity?
Yeah.
Dilution.
Well, dilution. The cost of debt is significantly lower than the cost of equity, and it was option. It was on the table. This was the round we were raising. It's nice to have a little emergency backup fund.
Yep.
It was a good move.
Yep.
It was a good move on our part. We're really glad that we added that they piggybacked on on that seed round.
Great. Thanks for letting me.
Yeah.
Thanks for letting me pull you a little bit aside there. So anyway, kind of coming back. So the bank basically said, "Hey, we're going to need you to get onto accrual accounting,
Yeah.
but we're going to give you a year or so to do that."
Right.
Right. Okay.
Right. So that was the impetus there. It's a lot of work, and when I knew that, if that's when I could have hired a controller, that's probably when I would have hired a controller. But being naive, not knowing the amount of work that goes into that, I was like, sure, I'll get some outside help, and I'll try to do this,
Yes.
and can make this happen. And I think we got half the way there before I realized that this is not a job for, in my opinion, this is not a job for an outside entity to come in and try to do for us.
Yes.
And it's a lot more work than you think it's going to be.
Mm-hmm.
And my advice with that is hire yourself a controller to handle that.
Yep.
And give them more than 6 months. Give them a year to get that under control, and then.
Does that tie into your earlier point about kind of pounding the table for that controller
Yeah.
a little bit earlier?
Yeah.
That you probably might think.
People won't hear you until a few months later.
Mm-hmm.
Then they'll bring it to the board.
And to your point, I mean, yeah, it's easy to raise venture debt when you're closing a new round, but it's not easy to get onto accrual accounting. And so you almost need to say to your CEO, hey, look, if it's likely we're going to be raising a new round sometime in the future, and if we are going to be adding debt as a component to that, it's a good idea to get a controller in here fairly quickly, right? Because we're going to need to make a pretty big transition.
Yeah, and I don't want to throw any of my colleagues under the bus. We're like, hey, let's push this as far as we can, because I would have done the same thing in their situation.
Right.
It's like, how can we grow the company? Controller is not seen as a component to growth.
No, I completely get it.
I think you could argue that it is.
Yeah. And I think you're going to probably get one earlier if you make that a bit more of a growth argument. And I think that's what you're saying is you should do.
The crummy thing about going from cash to accrual is that I really liked being able to open up QuickBooks and have a cash P&L and a cash balance sheet.
Yep.
It made it really easy to forecast and do all that stuff. You introduce accrual accounting, then all of a sudden those big prepaids from customers are now going into deferred revenue.
That's right.
So
right?
do you get any benefit from it besides the fact that you're just compliant and now have the loan? I mean, is there anything that you find useful from kind of accrual accounting?
Tons.
Investors.
Great question.
Really good question. Investors will care when you break even from a GAAP standpoint.
Yep. It allows you to compare ratio, like he mentioned earlier, ratios. So if you don't even know what your gross margin is on some level. Cash accounting, I guess you can get it, but I'm saying it's better it smooths out your revenue and your expenses. You get a better sense of a lot of the key ratios in your business.
I mean, I figured that's a lot of what we look at, because we were looking at kind of getting to break even for a long time, getting the profitability. But yeah, just kind of curious for your situation.
And you guys, speaking of break even, I said never. That was never, and I shouldn't say never because honestly, we dreamed about break even, and it was always
in the early days.
It was always like this milestone 2 years off in the forecast, right? That's important. I don't want to diminish the value of breaking even, but right now that's just as much as we want to.
Yeah, it's market share right at this point.
Yeah.
And that's what your investors frankly want. That's what your board wants, and it's probably going to make your company worth more.
Yeah.
So I think that's the right.
Yeah. So if you're going to be working with VCs and you're going to get debt, think about when that transition is going to happen.
Yep.
Pretty critically.
Yeah.
Because it could be a nightmare if your existing records are a mess.
Yes.
It's going to be a task, and you don't want to rush that task.
Yeah. Right. That's great. Maybe we should move on to the next topic. We might be getting close to the end because I know.
Yeah.
I think there were 4 or 5, and I know we've probably. Oh, we have not talked about reviews and audits.
We did touch on it a bit.
We did. Oh yeah, we did actually briefly. But is there anything more? Because I think that's a great place to kind of end.
Yeah.
I certainly don't want to miss, and we can again edit this out. Dustin, I don't want to miss anything that I'm looking at over there. I can't read it, but these notes are so valuable. So if there's anything you feel like we've missed, let's actually pause for a minute and make sure you've had a chance to kind of look through.
Let me see if I've missed anything. I guess just a couple closing points.
Sure.
We were talking about the cash budget, and I failed to mention probably the most important part of the cash budget. And that is you need leadership sign off on the budget process as a whole. If leadership is not pushing that, making that a topic of discussion, making that an important aspect of the business, good luck controlling.
Just
Good
won't
luck
happen.
controlling your costs.
Yes.
It needs to be made a part of how budget owners' performance is measured.
Yes.
And I remember a day when we came into this room and leadership said, "You know what? If you can't manage your budget, we will find somebody else to do it for you." So
meaning
it has to,
kind of like a
meaning you won't be doing your job.
thinly
It's part
veiled
of,
threat.
yeah, it's part of your job
Yeah, I get
as
it.
a director of a business unit, right?
Yeah,
Yes.
totally.
Yes.
And it's critical. It gives you so much credibility when you can say, "This is what we're going to spend," and you actually do what you say.
Yeah.
And anyway, so yes,
Neat.
crucial. Leaders need to push that
That's great.
because they probably don't care what the finance guy thinks
Yep.
or wants to do.
Right.
To be honest,
That's cool.
not to diminish the role, but that was it was the day that the gavel was pounded. That was really when things made my life a lot easier.
Yeah, and that makes sense because a lot of people they think that they want to control their own departments, and when you start saying like, "Hey, this is what you can spend or can't spend," that directly impacts someone else's department. And yeah, it makes sense that you need someone whose role is to be directly over that department.
Yeah, and those surveys that we do, the budget survey is what we call it again, that's super critical too. It forces the business unit leader to sit down, stop, get out of the day-to-day and think ahead like a CEO. And then I get the benefit of having all that information to build into the model.
And what a cool job to be able to own a business unit and think like a CEO. And a huge part of how CEOs got to think is budget based. So that's really neat. That's cool. So yeah, do you mind if we kind of finish up on kind of talking about the transition to a review and then to a full audit and kind of where you're at in that process and any advice you have in kind of preparing for an audit? We just actually published an article about kind of getting ready for your first audit. So it's a hot topic for us. Would kind of love to hear your thoughts about that.
Yeah, honestly, my involvement now that we have a controller has been minimal.
Great.
So, but I've been involved in, going to lunch with these audit firms. I helped pick our audit firm, but the brunt of the weight is being carried by our controller, thankfully. He threatens us. He tells us all the time, audit is no joke. I mean, you thought the review was hard? Like, buckle up because the audit's a whole
different ball of wax.
Yeah. Yeah. So as far as the preparation that's going on internally right now is
Get a controller.
we've now picked our firm.
Great.
Besides that,
Was it a different firm? And you don't need to name names or anything,
Yeah.
but was it a different firm than the one that did the review?
Yes.
Okay.
Yes, it was.
But the review still helped you get ready for this larger firm. So you're still really glad.
Most definitely. I mean, the new
There's no conflict there though, right? The same company you could have used the same company
Yes.
that does
Yeah.
a review to do your audit. Okay.
most definitely.
Just curious.
There may actually, I'm not sure because they do our tax work, so there may be
some kind of a test.
a conflict of interest there.
Conflict there.
However, gosh, I lost what I was going to say.
Oh, I'm sorry.
There's beginning balance sheet procedures. So, okay, starting over.
Yes.
Part of what goes into your first audit is something called beginning balance sheet procedures.
Okay.
And this has to happen regardless of whether or not you had a review. They're going to look. So if you're, for example, auditing 2017, they're going to have to go to the balance sheet as of December 31, 2016, if that's your fiscal year, and close, and they're going to have to audit those amounts. Because if those amounts are wrong, then everything else trickles and is wrong. So that's an added cost to your first audit, and it goes away on the subsequent ones. Advice.
Kind of a true up to get everything that's happened up till then
Yeah.
ready to go so that balance sheet is accurate.
Yeah.
And, for the non-auditors and for the less technical, your balance sheet really drives all your financial statements. And so that's a great starting point. I mean, you got to get that thing right. And then, everything should flow through all the proper reports in the right way. Your income statement, your cash flow. Yep,
Sure. Make sure you go on a lot of dates with different audit companies. Okay. Get a lot of bids. Get a feel for
make them take you to lunch a
who
little.
they are. Yeah. I mean, you're going to pay for it eventually. Right. You might as well go to lunch with them and see them outside of the office and see what they're like. See if they're human or not. Right?
Yep.
But then I lost my thought again.
No problem.
What was I going to say? Contracts.
Okay, contracts.
So you need to make sure before you have a review and before you have an audit that you have all of your contracts in a central location. And by contracts, I mean vendor contracts and especially your client contracts. Because with revenue recognition laws, what is it, ASC 606?
That's right. RevRec is such a pain.
They're gonna pound the hell out of that.
Yep.
And they're gonna do sampling, and they're gonna want to make sure
And they're gonna find some.
Yeah, you don't want to be caught with your pants down. You don't want to be missing contracts.
Yep.
And so get that all squared away, organized. Start that day one. Best practice day one is to cube and have all your contracts stored and organized. That's part of the beauty of the cube. You should have a column in your cube that says
contract.
Yes, no, and if no, hopefully that one doesn't come up in the sample. At least you know which ones you can't find. I mean, these are real. I don't know. I don't know if these are problems that are experienced at other startups. I hope they are. I hope we're not the only ones that have made these mistakes.
Right.
But
no, I guarantee you're not. I promise you.
Yeah.
Well, Dustin. I mean, do you mind if I kind of wrap up? I mean, Dustin. Honestly, it's been such a pleasure to talk with you. You have a lot of energy, which I really appreciate, and honestly, so much insight into the finance position in a startup. I mean, I come away from this feeling like, man, I kind of wish I had the opportunity to do that. Some really cool stuff. Obviously, some great tools that you've mentioned. We'll try to get the ones that we can for our listeners. We'll try to get some dumbed down, not dumbed down, but some sanitized versions, skeletons of those tools. But we really appreciate it. We're going to accompany this video with an article, so make sure you read the article. It'll have some more details and kind of highlight some of the key terms and maybe even explain some of the words, define some of the more complicated concepts that Dustin was using. Thank you so much.
Yeah, it was a pleasure. Thank you.
Thank you.
All right. Thanks, guys.
Yeah, that was fantastic.
Thanks
so much.